The top business stories live from the Sky Newsroom. More market mayhem as China and the EU bring in retaliatory tariffs on imports from the United States. The growing trade war leads to another day of global turmoil, with stocks plunging and a surge in the costs of government borrowing. Also today, in some good news, a new universal theme park is to open in Bedfordshire with a promise of billions of pounds for the UK economy. Very good afternoon. Welcome to Business Live with me, Darren McCaffrey, on this Wednesday afternoon. And it's been yet another day of turmoil on the markets as China and the EU both retaliated against Donald Trump's tariffs. The FTSE has again tumbled, with stocks falling also across Europe. President Trump, though, says he remains unfazed. This afternoon, he posted on Truth Social, "Be cool. Everything is going to work out well. The USA will be bigger and better than ever before." Well, China has announced it will impose an 84% tariff on American goods from tomorrow. That's up from the 34% that had been previously announced. And this afternoon, the European Union has said it will also bring in tariffs on around 21 billion euros worth of imports from the United States. Well, let's take a look at how the European and the markets have reacted. We're going to start actually with Wall Street and the Nasdaq. It's actually up a little bit today. This has been called the kangaroo market, if you like. It goes up and it goes down, quite volatile. At the moment, the Nasdaq 100 up more than 1%. Let's have a look at how the FTSE is doing here in London. It is just closed, though that is not the final figure, but it is going to be down today at more than 3% at the moment. And it is really pharmaceutical companies that have led the drops. Look at that. AstraZeneca down more than 7%. GlaxoSmithKline down nearly 6%. Now, why is that? Well, Donald Trump has said he's going to bring in tariffs, major tariffs on the pharmaceutical sector. And we're expecting maybe to hear that as early as later on this afternoon. Let's have a look at how Europe is faring today. Again, a sea of red. Most of the indices in the big economies down between 2 and 3%. Let's have a look at the currencies. Today, sterling is up against the US dollar, just a fraction at 128. Down quite significantly, it must be said, against the euro, 116. We haven't seen it as low as that for more than a year. Just a sign there of how the euro is strengthening, if you like. It is also up against the US dollar, almost a percentage point. And let's end with the price of a barrel of Brent crude, down 4% at the moment, hovering around the $60 a barrel measure. Well, let's speak to Fiona Cincotta. She is Senior Market Analyst at City Index. Fiona, very good afternoon to you. Another day of volatility.
Yes, completely. We've seen big swings. We've seen large drops in Europe. And this is as the investors continue trying to price in what these trade tariffs are going to mean. We're still very much in this idea of uncertainty as we get tit-for-tat measures from China, from Europe. So it's making it extremely difficult for the markets to actually assess what this actually means in the longer run. We've obviously seen Europe come in lower. Oil prices are down significantly, and that's as sort of the major oil consumers, the US and China, look to be sort of having a weakening impact with their economic outlook, which is hurting the demand outlook for oil. So still very much a sense that we haven't got to the bottom of this. Investors can't get an underlying picture of what this all means.
And Fiona, we're calling this, aren't we, the kangaroo market, if you like, because it is up and down quite a lot. And in part, that's because we've seen further retaliation this afternoon, more limited than what we had seen with China, but from the European Union.
Yes, that's right. So I think this is a step by the European Union to, indicate that they're not pleased with the way that things are progressing. And it's really interesting because despite this retaliatory move from Europe, and we've seen stocks down in Europe, but we are seeing the euro actually benefit from the sell-off in everything that is US. You know, it's as if investors are looking for some places to park their funds, to reallocate their funds, and the euro seems to be one of those benefactors, as does gold, safe haven, and the Japanese yen.
Yeah, as you say, gold is doing well. Why the euro, though? Because it does seem to have been at the expense of sterling. Is that because it's perceived as more of a reserve currency to a degree?
Exactly that. You know, if you're going to compare sort of riskier currencies between the pound and the euro, then the euro is considered to be slightly less risky than the pound. And that's why we're seeing that sell off. There are obviously concerns over how these tariffs could still impact the the European Union, given the fact that it is expected to slow growth. But even so, we are still seeing that the markets are looking to allocate their cash somewhere, and the euro does appear to be that place.
And Fiona, we're all waiting with bated breath yet again this afternoon, the real possibility that we're going to see tariffs slapped on the pharmaceutical industry. And that's why shares are down quite significantly.
Yes, and it just really does highlight the fact that we just don't really know what's coming next. This doesn't seem to be at an end. And whilst we're still getting new tariffs placed, new tit-for-tat measures, then it does make it, as I said, difficult to actually understand where this is going. As a result, we've seen sort of banks, which are very much economically, a sector that's very economically sensitive, under pressure as well.
OK, Fiona, thank you very much indeed for your time this afternoon. Well, that growing trade war has led also to a rise in the cost of government borrowing. Our economics and business correspondent Gurpreet Narwan has been looking at the rises in that government borrowing and has more. Gurpreet.
Well, Darren, stock markets are in disarray, and it's times like these you would expect investors to be looking for safer options like government bonds, for example, especially US Treasuries, the bedrock of global financial stability. But let's take a look at what's happening with US government debt. This is the 30-year Treasury bond. And over the past few weeks, investors have been pulling money out of stocks and buying bonds. That's pushed the price up. And as you can see here, the yield down. Unsurprising, perhaps. But since Monday, something's changed. Investors are now pulling money out of stocks, and they're ditching treasuries too. The price of the bonds is falling, and that means the yield is rising. And that's dragging government borrowing costs around the world higher, including here in the UK. Yields on Britain's 30-year government bonds have hit their highest level since May 1998. And today, they're on track for the largest one-day move since the aftermath of Liz Truss's mini-budget in October 2022. Rachel Reeves will be watching that nervously because that's going to eat into her fiscal headroom. But then the question is, why is this happening? Well, there are a few things that could be going on. First, there's the mechanics of the markets. Investors selling bonds to cover losses elsewhere in their portfolios. We saw that happen in 2020. Remember the dash for cash, when the Federal Reserve had to step in to shore up the markets. And central banks, well, they're on standby this time too. And then, on a more fundamental level, investors could also be telling us that they're losing confidence in the safe haven status of US government debt. And we can see that reflected in the performance of the dollar too, the world's reserve currency, one of the world's safest places to be parking your money. And as you can see, it's been on a bit of a journey since Trump was elected. But the overall trajectory is down 1.15% against a basket of safe haven currencies since last Wednesday, Liberation Day. And some are also wondering if China could be behind some of this, dumping government debt as a revenge tactic. Trump has, after all, said he's trying to bring government borrowing costs down. And if that is the case, well, then the US-China trade war could rapidly be evolving into a financial war too.
OK, Gurpreet, thank you very much indeed for that. Let's bring in Reza Ahmed. He is Chief Executive of Wise Alpha. Very good afternoon to you. This is clearly quite significant. Just talk us through the consequences of this rising cost of government debt.
Very good afternoon, Darren. Yes, so we're seeing a slightly different a market approach in this retaliatory, tariff environment. There's generally a consensus that this is going to slow growth as people delay purchasing decisions, and at the same time, there is concern that central banks are not able to have the same policy flexibility that they have previously in order to step in and change or reduce interest rates because of the inflationary environment we're in. So there's two things here. Look, there's the concern about what could happen to economic growth, but there's also the concern about, the feed-through effect of, retaliatory tariffs, around the world, increasing the costs and effectively pushing through inflationary price impacts.
Yeah, and it's troublesome for the White House, clearly. I mean, the US government is quite heavily indebted, but really quite significant for us here too, in the sense that Rachel Reeves already has very little headroom, and effectively she's ruled out tax increases, she's ruled out changing the fiscal rules. It does really start to get quite tricky.
Yes, it does. I mean, look, as you've seen, yields have risen, over 0.5% on the 10-year, and that's also going on to the 30-year gilt rates as well. And so, there is very limited policy flexibility here. I mean, they're going to have to consider, what they're going to do with tax rates and potentially maybe change some of their previous forecasts.
And just in terms of the consequences of where we are with the United States, I mean, does it get to a point where actually politics has a part to play here and people say to Donald Trump, this just simply isn't sustainable, if you like?
Well, so the US has a very clear defined policy that it needs to change the rules of the trade game. So they're looking to create a much fairer trading system for themselves and to reduce some of the trade deficits with key nations across the world. So they've made that very clear to China, to Mexico, Canada, India, and the EU. And so this is something to stay. And so there's going to be a few weeks of, I guess, market uncertainty while people work out how this is all going to play out. There are going to be negotiations. There will be, particularly amongst countries who have a very close relationship with the US, both from a security standpoint and a trade standpoint, there will be deals struck. But I think what people are looking at is some of the dynamics that are going to play out between the EU and China, where there's a little bit more of a kind of a tougher approach to the negotiation.
Well, I suppose that's my fundamental point, though, is, and you talked about what's fundamentally at play here is that uncertainty. But at the moment, the problem is for everyone is there's no sign that that uncertainty is going to go away. In fact, that it's been essentially entirely manufactured by said White House, by the Trump administration.
Well, look, I think, the Trump administration's always been clear about what they intended to do. I think maybe the market thought there might be, some extra time for negotiations to occur. They didn't expect that there would be a simultaneous, tariff policy across the entire world. And I think a lot of people were surprised about the kind of amount of the tariff rates that were announced and the formula that was used for that. But they've always been clear on that. And I think, now I think everyone is, understands that there is going to have to be a negotiation. And so I do think that, yes, there'll be a few weeks here, tough negotiations. There'll definitely be some very interesting dynamics going on. That is going to affect the volatility, both in the stock markets, but also it will see, moves up and down in spreads, both bonds as well as corporate bonds, which will be potentially interesting opportunities for investors to make money, obviously, in volatility.
OK, Reza Ahmed, thank you very much indeed, the Chief Executive there of Wise Alpha. Thank you. Well, let's talk about luxury goods. Of course, Britain sells a lot of luxury goods to the rest of the world, particularly to the United States. And in the wake of those Donald Trump tariffs, there have been calls for the UK government to reinstate tax-free shopping. Will it happen? Let's speak to Helen Brocklebank, who is from Walpole, the official sector body for UK luxury goods. Very good afternoon to you, Helen. Just give us a sense of how important the luxury goods market is for the UK? Because we do export quite a lot, but we also sell quite a lot, particularly in London, for example.
It's a sector that is a huge high growth sector for the UK economy. It's worth £81 billion here in the UK. It's brands that you would recognise, like Burberry, Church's Shoes, Wedgwood, Aston Martin, but also lots and lots of SME. It exports 56 billion of that, 81 billion, so nearly 2/3 of what it produces is destined for exports. But most importantly, it's a sector that supports nearly 500,000 really, really good jobs nationwide. So its contribution to the sector is hugely important. So that's why we're really worried about the tariff impact and looking at ways to mitigate that with things like reinstating tax-free shopping.
So what difference would that make in terms of what are you hoping for it to achieve here? That more goods are sold in the UK?
Well, if tariffs makes famous name British goods expensive for US citizens in America, we want them to come here, and should be rolling out the red carpet for those high value US visitors to come to the UK and buy their famous name British goods that they really love here in the UK. Because what we know is that for every £1 a high value visitor spends on a nice hotel, say, £8 goes to the local economy in retail, in culture, in the whole restaurants, the whole thing. So it's a real dividend that could be unlocked just by unlocking this the policy that this government's inherited from the last one.
Now, a new universal theme park is to be built in Bedfordshire, with the Chancellor saying that it will bring billions to the economy and create thousands of jobs. The park will be built by Universal, which is owned by Sky News' US parent company Comcast, and is set to open in 2031 in Bedfordshire. The company says that the park will bring an extra £50 billion into the economy by 2055 and create around 28,000 jobs, both during the construction phase and once the park opens. A 500-room hotel, retail and entertainment complex is planned alongside the park, with around 8.5 million visitors expected in the first year of the opening, which would make it the UK's most popular tourist attraction. Well, Universal has released this artist impressions of the theme park, which will be built on a 476-acre site just south of Bedford. Well, earlier the Prime Minister and the Chancellor visited the site of the new park, and they were joined by the President of Comcast, Michael J. Kavanagh, who explained the decision to expand in the UK.
UK obviously is a logical place for a park like this, given the creative industries of the UK, given the workforce in the UK, given the importance of tourism to the UK, the access to transportation, the access to continental Europe. So all that obviously stacks up nicely.
There you go. Some good news to end on, of course, Universal, big film franchises such as Jurassic Park, Shrek, Minions, amongst others. As I say, that is planned to open up by 2031, so some good news. Well, that is it from me on Business Live for today. Just to bring you up to date with where the FTSE ended on this Wednesday, another day of turbulence on the market. It was down 2.92% today. It's been called a kangaroo market day because we've seen markets go up and down, particularly in the United States, but the FTSE finishing down yet again today. We'll have more on Business Live tomorrow morning at 11:30. Stay tuned, though, for Mark Austin on the News Hour. That's up next here on Sky News. Have a very good evening, and I'll see you again tomorrow morning. Goodbye.